Hello everyone, it is our trades back here with another video on X and YouTube, guys. In this video, we're going to be talking about why today, Wednesday, July 30th, 2025, was a dangerous day for the day traders. I'm going to talk about why that is. There are going to be some of you that are going to say in the comments below, if you comment, that it was a great day for you, you made a lot of money, I'm full of it. I understand that. I'm going to talk to you about why I think today was a difficult day and why for most day traders it was probably best to avoid today. Even if you happen to make money, it was probably more or less luck. All right, guys. With that being said, please make sure to follow me on X. Hit that heart button, the like button on this X post. Make sure to go over to YouTube and click the subscribe button. All right, guys, now that I'm no longer affiliated with any prop firms, I can get right into the content and try and keep these videos relatively short. As many of you know, I trade micro futures, and that is I trade the micro S&P 500 futures or the MES futures, and so that's what we're going to be looking at today. Guys, I trade a very simple system. As many of you know, check out my video on my day trading system fully explained. Basically, I trade a 5-minute chart with a 9 EMA, 21 period EMA, RSI, and ATR. I try and enter in all of my trades at or above the 9 or 21 EMA if I'm going long, or at or below the 9 or 21 period EMA if I'm going short. So I try and follow basically trend following, and I try to enter in on limit orders. Not necessarily saying that I enter all orders at EMA touches. I don't do that, but I try and generally follow the trend. Okay. Now, today, as many of you know, Jerome Powell and the Federal Open Market Committee, or FOMC, came out with a rate decision in which the Fed held interest rates between 4 and 4.5 points, or is it 4.25 to 4.50 is the benchmark rate. All right, this is after a lot of pressure from President Trump to lower interest rates. Obviously, they haven't been lowered. I'm not going to get into the politics of that, but I will tell you that interest rates remain the same. There were two dissents. All right. So with that being said, we can see from today's action here on the 5-minute chart that we came in the day and we were mostly trading within what I would like to call an algorithmic range. So that's where trading algorithms are going to keep you largely within a defined range. And so for the first, prior to the FOMC release, which I'm blocking off here, you can see that the trading algorithms kept us largely within an 18 or 19 point range between 64.02 and 64.21. You can generally tell that it's mostly algorithmic price action by the way that it's kind of stuck in a trading range of a predefined points. So the algorithms, the automated systems definitely had control of the market prior to the FOMC release. Now, during this period overnight and coming in before the FOMC release, this is difficult to trade, and the reason is because the market, unless you're a trading robot, the reason that I call that difficult to trade is if you go long and you go to work, or you try and leave a position on for a runner, not knowing that it's FOMC, something like that. You should be aware it's FOMC. You're going to get stopped out, and if you try to go short, you're going to get stopped out. So basically, a trend following system is just not going to work in that environment. And where the market is whipsawing a lot, yeah, can you make money in that environment? Absolutely. If you have a system that likes to follow that trading range or whipsaw, but as soon as the market gets trending, you're going to get burned. And so generally speaking, I think the research shows, and it would be my recommendation for the majority of retail traders to use a trend following system rather than a mean reversion system. All right. So with that being said, as we came into the interest rate announcement and before earnings releases, things like that, at the second half, we had an expansion down. So this occurred starting on we first had a pop up about 10 points, and then we had a significant move down. So 55 points down. We reached a low of the day of 63.6675 at 15:05 Eastern or New York local time, guys. So we had quite a move down, and so from peak to trough, that was 63.25 points, 63.25 points, or about 1% in the market. Then we came all the way back up. All right, all the way back up, and now from peak to trough, the market went up 69 points. All right, so why do I think that today was a challenging day? Although I will tell you that I made some money. Nevertheless, I think it's a challenging day and probably a day that most retail amateur day traders should avoid. All right, and that is because if you had assumed or gotten cocky that the market was initially going to move higher, you got burned. If you assumed or if you got cocky or you were trying to let your winners run on the short side, you got burned. Now the market is expanding higher and higher. We gapped up during the resettlement. All right, and the market is adjusting to NVIDIA, Microsoft, I think both came out with earnings or had news events, and the market is rolling off of that. So I think there's also some tariff news right now. I think if you're a retail trader and you're trying to follow a basic, moving average trend following system, kind of like I am, it's going to be very difficult for you to do that. So all in all, guys, you're going to hear a lot of professional advice saying that you should avoid trading on FOMC days, and I think that Wednesday, July 30th, 2025 is largely the same. If you want to trade days like this, you have to be aware that a lot of the FOMCs have this kind of two-stage macro where it goes one direction, then it goes the other direction, and you kind of end up as a wash. But every once in a while, you get just one direction, and they can happen. It happens fast. Next thing you know, you're broke, and it took all of 5 minutes, and you're in a really bad position. So, I think for the most part, the advice is correct that you should probably avoid trading FOMC, and I think that the price action on July 30th for most people suggested that as well. Now, I'm going to get people in the comments that I know are going to say, well, I made money today. Hey, I made some money today as well. Not a lot, but some. But I fully recognize that this sort of whipsaw action where we're up and we're down and then we're back up is difficult for retail traders because you're getting washed out both ways. You really think the market's going to move strongly with conviction and for a prolonged period of time in one direction, and then it just doesn't. It drops real fast, comes right back, pumps higher. Can you trade that? Absolutely. Of course you can. Do I think most people made money trading this action? Probably not. Also, if you've watched to the very end of the video here, I want you to comment in the comment section below or on X, how many prop firm accounts do you think got blown today? So I no longer trade with prop firms in open disclosure, but I have before, and you got to wonder how many evaluation accounts were blown today, how many accounts were reset. The prop firms have recently made it to where you can trade during news. Most all of them say you can trade during news now, and they got to be making money on that, man. I think it's over 9,000 accounts blown today, especially those people not ready for that volatility. So with that being said, guys, I think that if you're being wise, you're being cautious, you're really trying to play the long game, probably best that you avoided the market today. If you made money, then props to you. Otherwise, I will be back tomorrow with another video.